Good morning, everybody. I hope you've grabbed a coffee or another warm beverage because it's very cold out there today. We are in for a great webinar this morning, very timely after what happened last night as well. So we couldn't have predicted it even if we'd have wanted to. I'm Greg Taylor. I'm a partner at MHA McIntyre Hudson, and I'm the head of banking and finance at the firm. My banking and finance team provide many advisory services to clients, including sourcing of finance, asset finance, working capital and the like, but also banking consultancy services and debt advisory services. Also, as part of our remit is foreign exchange services, which obviously couldn't come at a more timely fashion in the context of the current volatility that we've seen in the markets, especially since the Chancellor stepped up to give his now infamous mini budget. There are many challenges, let's be honest, facing businesses right now, but one of the most urgent, I think, and most time sensitive is what is happening with the foreign exchange volatility roller coaster. That's why today I'm really pleased to be able to offer this webinar with our partners at MoneyCorp to help give businesses some understanding and guidance. Before I hand over to our first speaker, Max Huseyin from MoneyCorp, just a couple of bits of housekeeping, please. Any questions, please feel free to pop them in the questions and answers box at the top. And also a recording of this webinar will be available shortly after we have concluded so that you can pass it on to somebody else or rewatch it if required. It gives me great pleasure to hand over to the guys from MoneyCorp and Max Huseyin.
Thanks very much, Greg. Good to meet everyone. So I'll kick off. So my name's Max Huseyin. I'm a senior account manager in the partnerships team at MoneyCorp, and I look after the partnership with McIntyre Hudson. MoneyCorp have partnered with MHA to assist their clients in managing their foreign exchange risk in both the private and corporate space, and it's great to have the opportunity to present to you. At the end of the presentation, you'll have been updated with what's happened within the FX markets in recent weeks and what the immediate, medium and long-term risks are. And as Greg alluded to, like now is the time to be taking note of this as it affects businesses and individuals around the world. Then we'll take a look into the future and how exchange rates could look as we head into the end of 2022 and the start of 2023 via some collated banking forecasts. And importantly, we'll be bringing this to life by sharing a couple of working examples on how MoneyCorp have helped clients through this difficult period of volatility. We'll then finish by looking at the wider risks posed to corporate and private clients before opening up for questions. We do have some time scheduled for the questions at the end of the presentation, and you've got your panel of speakers here, and full contact details will be provided. So just a bit on MoneyCorp. I'm aware some of you may be meeting us for the first time. We're a leading payment service provider for banks, businesses and individuals, and we're committed to helping our clients navigate the complex world of global payments, as well as being the preferred supplier for MHA, their partners and their clients. Over 11,000 businesses and partners globally trust us for our dependable service and cutting edge technology. We're consistently at the forefront of the market, and we focus on creating a balance between shaping the future of the payment industry and building meaningful and enduring relationships with our clients. And I feel this puts us in an excellent position to provide some guidance for you all on the call today. With that, I'll hand over to Joe Calnan to take you through the next set of slides.
Hi, good morning, everyone. My name's Joe Calnan. I'm one of the managers on our corporate dealing team at MoneyCorp. So here at MoneyCorp, we've got 15 corporate dealers split up into teams of three, teams of five, three teams of five, and I manage one of those teams. We also have a private team made up of 8 private dealers who deal with our private clients. There's obviously a lot of crossover between those two, with a lot of our private clients owning businesses and a lot of our business employees having private accounts at MoneyCorp as well. In our corporate team, we have clients from micro-sized business up to FTSE 100 companies, and we like to tailor our FX and international payment solution to each of those businesses. So that goes from providing a simple MoneyCorp online platform for clients to book small regular spot deals for their business, up to a holistic FX hedging solution, including forward contracts and structured regulated products such as FX options. I'm just going to run through, so quick look back at sort of the last few months. Obviously, it's been a bit of a wild roller coaster over the last few months. So looking back to August, unfortunately, the pound was the worst performing currency amongst the G10 currencies. September was no better, with it being the worst month for the pound since the Brexit vote in 2016 and the global financial crisis in 2008 before that. The bad news came thick and fast for the UK. Inflation spiraled, GDP growth has contracted, as we've seen today, and the outlook for 2023 is damning. And the rotten cherry on top was the Truss government's growth budget. Whatever your political leanings, the new policy direction was taken very badly by markets. That's undeniable. Stocks, UK government bonds or gilts, and the pound sold off considerably. The Friday of the mini budget was the 7th worst day for the pound against the dollar in the last 50 years, and that was followed on the Monday by a fall to the lowest level ever against the US dollar. Up to a week ago, the pound had regained most of its losses, but the Bank of England restored some order in the gilt market, which averted disaster. That's obviously very topical as of last night. And the new government promised fiscal responsibility. However, the fundamental reasons underlying the pound weakness have not gone away, and the pound will, in my opinion, continue to fall on the same trend line over the coming weeks and months. We're currently sitting, just looking over my Bloomberg terminal, so currently sitting at 109.80 on sterling dollar and 113 almost bang on sterling euro. So obviously the pound, after that news last night that the Bank of England are going to stop the intervention in the gilt market, the pound has fallen off. And then on top of that, the GDP number this morning from the UK for August was obviously minus 0.3% month on month. So looking like that downturn in the economy may be coming a little bit sooner than later. Moving on to the next slide. So in my view, there's, Max, if you just move your mouse, that'd be great. Thanks. So in my opinion, there's if I break it down to short term, medium term and long term risks. So short term being this month. My feeling is that obviously UK and US GDP and inflation will be the biggest risks this month for FX markets. We've seen UK GDP out this morning, as I mentioned. US inflation data is tomorrow. UK inflation data is out next week. And those two releases will be very much focused on by FX markets. In normal times, high inflation equals higher interest rates, which equals a stronger currency, better return on your money. I think that will still be the case for the US. However, UK inflation spiraling, I think that a lower inflation number, contrary to normal times, may be beneficial for the pound, as it would hopefully point towards more positive growth, GDP growth in 2023. Moving on to the second point, in short term, the UK government have brought forward their medium-term fiscal plan to the 31st of October. The announcements, as I mentioned just a moment ago, of tax cuts and freezes back in September caused a huge sell-off for the pound, and as we know, mostly that was due to the absence of a sound fiscal plan. The hope is that by the end of October, they will have that fiscal plan together, and it will be very convincing. But of course, there is a chance that it misses the mark and we see another big sell-off. In the medium term, just moving over to the next bit there, I think obviously the Russia-Ukraine war, along with energy crisis or prices in Europe and the UK, will be a big risk, or continue to be a big risk going forward into the next 2 quarters. Russia's invasion of Ukraine obviously sparked the current energy crisis, and the escalating Russian aggression towards Ukraine is increasing global uncertainty and increasing market risk. Up to now, this has resulted in a huge flow towards safe haven currencies, mainly the US dollar, because the Japanese central bank have been unwilling to discuss interest rate rises. If that situation changes in any way, and obviously we hope it does in terms of the Russia-Ukraine war and de-escalation, it could lead to a flow away from the US dollar and into other assets. So potentially reversing the move that we have seen. So those are the kind of two sides of the coin on that one. Slightly longer term, going forward to the end of next year. Again, these 2 points are very closely linked. There's a big chance of global recession, and there's also a chance of interest rate divergence, which will set different economies on different paths. Looking at the chance of recession for next year, or within the next year, the UK currently is sitting at a 60% chance, according to Bloomberg Analytics. The US is at 50%, and the EU, including the German economy, is at 70 or 75%, which, depending on which data point you look at. These recessions may be needed to reset the global economy, bring down inflation, and bring in a new economic growth cycle. But they will certainly cause a lot of FX volatility, and the path becomes clear as the path becomes clearer. We'll see this in detail on the next slide, but some central banks, such as the Reserve Bank of Australia, are already starting to taper their interest rate hikes. They feel that they've done enough already to bring inflation down. Others, such as the Bank of England, as we'll see, feel they're just getting started, and especially with this policy change. So I'll draw your attention first to this bottom table here. The two banks I spoke about there, Reserve Bank of Australia, they're starting to bring their interest rate hikes down. There's an 85% chance at the moment of a 0.25% interest rate hike, and there's a small chance of a no change, so they're not going to change their interest rates. Compare that to the Bank of England coming up on the 3rd of November. There's currently I think this actually dropped overnight, but around a 60% chance now, I believe, of a 1.25% interest rate hike, and a growing chance of a 1% hike. A lot of analysts are actually calling this 1% hike now, but there's a long time between now and the 3rd of November, so I will expect that to change quite a bit, I think. We obviously will send these out, but these are great tables to look at in terms of what might be coming up over this month in the short term, and then over the next central bank meetings over the next month and a half. So every month we also send out, MoneyCorp also send out a roundup of the bank forecasts. So this again comes from Bloomberg Analytics. So we gather the most recent bank forecasts from some of the biggest institutions in the world. We put them into this kind of format on a PDF, and we send them out to a lot of our clients. So just having a quick run through of this. So this is sterling dollar. In the near term, a lot of banks are forecasting pound weakness. If you look over to Wells Fargo, Morgan Stanley, there's obviously chances according to those banks, that we're going to go down to parity against the dollar and close to for the next few quarters. In the longer term, however, if you look at the median and the mean here, the expectation, the general consensus is that we will start moving in a pound positive way, hopefully as the risk on market comes into play. So more risk on in the market will mean more pound strength or more dollar weakness. Moving over to sterling euro. Again, there's potential for pound weakness in the near term, but generally the UK and the European economies are very closely linked despite Brexit, and so we see this kind of flat line for sterling euro. So over the longer term, we're generally seeing that those rates stay fairly close to where they are right now, especially compared to the volatility that we're seeing against the dollar. Moving over to euro dollar, again in the near term, very much expecting euro weakness, dollar strength. However, over the longer term, there is more of an expectation of dollar weakness as the risk comes off in the market. And that's it from me on the market update.
Thanks, Joe. Very insightful, and I'm sure we'll have a number of questions at the end or following up based on your summary. So thank you very much for providing that. I'm now going to cover off some client scenarios just so that you can see how MoneyCorp are assisting clients through this period of volatility. Okay, so as I mentioned at the top of the call, my role is as a partnerships manager. I look after partners like McIntyre Hudson who refer clients into us. So I sit within our private division. And in February this year, I was introduced to a client looking to begin building their global property portfolio, initially looking at purchasing a property in France. So I had an initial consultation with them where the client was only looking at their bank and unhappy with the service, the costs associated with doing that, and mainly on the guidance that they received. So they decided to open an account with MoneyCorp. This gave the client access to a dedicated currency specialist to assist her managing the risk associated with the purchase. As per Joe's charts, the sterling euro graph, whilst volatile at the time, was not as volatile as we've seen in recent weeks. So initially, the budget level was set at 116 to allow for any negative currency movements. In this example, it took the client to the end of September, as you can see from the chart on the right-hand side there, to actually agree the financing options. And you can see that we saw a significant amount of volatility during this period. When the funds became available, sterling euro dropped to 111, so the budget level was readjusted to 115, which was the lowest possible rate to make the property a viable investment. The client placed a market order to try and catch the market on the way up if sterling recovered. For those that don't know, a market order is an order to buy at a predetermined rate as it becomes available. So, for example, sterling euro today has just dipped below 113. If a client was looking to achieve 113.50 buying euros, we could place a market order and then, if that rate becomes available, automatically secure it on the client's behalf. So we placed a limit order for this client and it was secured overnight on the 2nd of October. This allowed the client to complete the property purchase at an acceptable level. A big consideration here is the impact FX markets had on the client's available euros. As you can see in the bottom right-hand side, a variance of 228,000 euros is the difference between the high and the low level that we saw over this time period. Now, it goes without saying, if the finance was agreed sooner, there would have been other options that would have been available to the client. And it's easy with hindsight to say we could have managed it slightly different. But it's important that through the service that we provide, the client was aware of the options that they had available. And it would be great to have understood them earlier in the process, but we were able to manage them through this period of high volatility. A couple of things to consider as well, just from a cost perspective of the volatility that we've seen this year. So if you look at sterling euro, a 13.5% move from high to low, and cable over 33.5%. From a private perspective, like that's the difference between affording a house purchase. For those repatriating funds back to the UK from a salary perspective as well, 33% on sterling dollar is going to make a huge difference to the actual net income of any individual. And we've seen a huge increase in recent years of private individuals working in the UK for US firms that have to take dollars. And we've also seen a big uptick in the number of those clients locking in the exchange rate at near record lows to take advantage of the positive currency moves that we've seen. And then if you consider it from a corporate perspective, 13 to 35% can wipe out any profit a company plans to make depending on the budget level they set. Now, we're going to go into a client scenario from a business perspective in a moment that really highlights how this can impact businesses. And we're working with them to ensure that they have the appropriate budget level set, but also the appropriate tools in place to ensure that they can meet that budget level throughout the year, despite the volatility that we see in FX markets. So having the appropriate planning in place will help both private and corporate clients mitigate the risk associated within the FX markets. With that, I'm going to pass over to Krissy, who's going to take you through a corporate client scenario.
Hi, everyone. My name is Krissy Rogero, and I'm the head of corporate partnerships here at MoneyCorp. I manage a team of 4 within the corporate partnerships team and work closely with Max and the private partnerships team, as well as with Joe and all the corporate dealers. The corporate case study I'll be talking about is a global publishing business that came to us looking to explore alternative currency solutions from their bank due to a recent project the company was working on, which caused the business to lose over $20,000 in one single invoice. As well as that, their bank were offering no alternatives other than trading spot through their online platform. So on the afternoon of the 12th of August, we set up an initial call between us and the managing director and the finance director of the company. On the call, we found out that the company receives payment in US dollars and that this is their transactional currency, their base currency. We also found out that they have subsidiaries in Canada, Australia, and the UK. So to support all entities, monthly payments of US dollars into CAD or Canadian dollars, Australian dollars, and sterling is required. A few days after the call took place, the company sent all over their relevant documentation and the account was open. The account manager assigned to the account called the company, welcoming them to their new corporate FX account. On this call that took place with the company's accountant, it was clear that there were significantly more currency requirements than we first thought. The business works out a costing level for the year on US dollars into Canadian dollars, US dollars into Australian dollars, and US dollars into sterling, but has never been able to secure a contract to budget their year in advance until now. I thought I'd circle back to the main point the client inquired about us in the first place. On the graph on the right-hand side shows the movement of euro dollar between October 2021 to October 2022. The invoice for the company was sent in the middle of February, where euro dollar was at 113.50. The funds arrived at the beginning of August and was then converted by their bank at 102.50. This specific invoice was worth 200,000 euros of US dollars, which when priced in February would have got them $227,000. But when the bank converted the funds in August, they ended up with $205,000. So a loss of $22,000 and a loss of 10% of their total contract. This was because they were unable to hedge in February for 6 months, which we would have been able to do for them. We also discovered that the client was receiving other currencies aside from US dollars into their US dollar account, resulting in their bank automatically converting the funds to then be allocated. We worked out that over the course of the year so far, it's cost them $10,000. After the call with the account manager, we were able to set up a £2 million credit line with a 0% deposit to implement the required hedging strategy the business needed. The client has since then booked 10 separate forward contracts worth £800,000 until the end of 2022. So the client has now been given the ability to lock in their currency needs in advance above costing levels for the next calendar year. And we've managed to save them a circa of $50,000 year on year, as well as giving them the account that can hold multiple currencies other than US dollars. A week later, the strategy was also approved by the parent company, and the requirement for 2023 has also been locked in. Thank you all for listening to my corporate case study, and I'll now pass over back to Max.
Thanks, Krissy, really insightful. Okay, so with that, I think we're going to open up to questions. I believe, as Greg mentioned at the start of the call, there's chat function where you can put your questions in. Greg, have we had any in so far?
We've had a few questions, Max. Do you expect to see sterling to continue to come under pressure following the news overnight?
I suppose I'll take that one. Yeah, absolutely. There's the reduction or stopping of the intervention by the Bank of England will obviously leave UK markets up to increased volatility. I think that it will increase a risk off attitude in markets, so people taking risk off the table, buying into the dollar and other safe haven assets, and moving away from the pound, and moving away from UK equities. So I would say that yes, that I definitely expect the news overnight to negatively affect the pound.
Okay. Do all corporate clients have to call into trade with their account manager? Is another question I've got.
I guess I can take that one. Thank you, Greg. So no, you don't have to call in and speak to an account manager. We do have an online platform that does cater to 34 of our major currencies that can be traded. Although if you are looking to unlock MoneyCorp's full potential, we do have the ability to trade over 120 currencies, which you have full access to if you just give us a call and speak to one of the corporate or private dealers.
Brilliant. Thank you, Krissy. And the last question I've got for the moment is, I have a potential client that could benefit. How do I introduce them to MoneyCorp? There's another question I've had in there.
Great question. I'll take that one. So as part of the value add that McIntyre Hudson clients receive from the partnership with MoneyCorp is every client's entitled to a free currency consultation, be it private, corporate or payment solutions. So all you need to do is email foreign exchange at mhllp.co.uk, as you can see on the screen, and we can arrange for that consultation to take place. The idea here is to assess your current process and then understand if that meets your requirement or make some recommendations based on your situation. Perfect.
There's a question in the chat box. I don't know if you, in the questions and answers, if you want to have a look at that, Max.
Let's have a look. Not sure I've got access to the chat box. Roughly how much would be saved selling 100,000 euros, I think it is, at spot via MoneyCorp rather than Barclays? But it's a really difficult question to answer. However, I think from a cost perspective, our aim is to ensure that our clients receive favourable exchange rates versus banks and other providers. The main element of what we do is in the service aspect as to what we've discussed. So ensuring that the client has the relevant process in place to manage that conversion at the right time. Converting 100,000 euros now versus 24 hours ago would net a very different outcome. So we're going to be competitive on the exchange rate versus Barclays, other banks, all other providers, but where we will be standout is in the service that we provide to all of our clients. And would welcome a further conversation on that. So please do reach out.
Yeah, and I think that's the point of what we're trying to get across today. It's about strategies rather than just what spot rate might be. It's about hedging the risk, etc., etc. And I think that's what that's clearly, you know, with the volatility, what we're trying to get across with the guys from MoneyCorp, a longer term strategy rather than what might happen today, which clearly is ever changing at the moment. I'm sure it's probably changed while we've been sat on this webinar, unfortunately. So some of it may be relevant already. Any other questions or anything else anybody would like to ask while we've got the guys from MoneyCorp here? Wait. Nope. I think that's it. Thank you very much for joining us.
I'm just going to say something else, Max? Yeah, I just want to recap what we've covered because I think it's important. We've covered a lot in a short space of time. So the FX markets have been particularly volatile throughout 2022. And with the inflationary pressures, interest rate divergence, the Russian war in Ukraine in the background, it's essential that anyone exposed to the foreign currency markets has an appropriate solution in place. So as I've mentioned, please do reach out to foreign exchange at mhllp.co.uk to arrange a free consultation. And also as well, to keep updated of current market conditions, you can also sign up to the MoneyCorp Daily Brief by scanning the QR code that's on your screen. And reach out to the email address as discussed. So it's been a pleasure for all of us to have the opportunity to present to you and look forward to speaking to you, some of you in the future.
Brilliant. Thank you, Max. Been really helpful. Thanks to all the guys from MoneyCorp for their input today. Really, really helpful. And as Max said, any questions, please reach out to the email address there, scan the QR code, and we'd be delighted to speak to anybody that wants a separate offline conversation. Thank you for joining us this morning.